Hey folks, Scott Rinehart here, and this month we are talking about the election and the election and the effect it has on your investments. This week we're going to talk mostly about the S&P 500 and kind of how it's performed in history. Not going to get into Republicans, Democrats too much today. That's going to be maybe next week, but we are going to get into some of that this month and really just give you some information of how elections have affected investments in the past and what that might tell us moving forward here in 2020. So the first thing we want to look at is, does the S&P 500 have the crystal ball when it comes to elections? The S&P 500 has predicted 87% of elections since 1928, and it's been perfect since 1984. What that means is it just means that if the returns in the preceding 3 months before the election were positive, the incumbent wins, and if they're negative, we get a new president. So basically, the S&P 500 has been a great predictor of who is going to win that election. And it makes sense, right? If things are going well, the president that's currently in office has a better chance of getting elected if the stock market's doing great. And obviously, if things are going poorly leading up to the election, then people might want some fresh blood. Now, 2020, obviously, we've got a whole lot of other stuff going on. So I expect that things will be a little different. Right now, the market is up, though, to start off this 3-month period before the election. All right, presidential election years throughout history. You know, what this chart is telling us is that when a new president is elected, so for instance, if Biden was elected this year, that's saying that historically that year, the market has done a little bit worse than how it's done if the incumbent president wins. But one thing I want to point out is that no matter what, the S&P 500, the stock market, has done pretty darn good during election years. It's averaged 11.3%. Now you'll notice that bonds, which we don't own a ton of bonds, but you'll notice that bonds have actually done better when a new president is elected. And that's because markets just don't like uncertainty. So when there's a new president that has a new set of policies and we don't know how those are going to play out, that just means there's uncertainty in the market. And so people are more likely to shift their money out of stocks into bonds, and, you know, returns quite as good, but they've still been pretty good. Now, what about the year after the election? How have returns compared to election year versus the year after? Well, over time, the S&P 500 has done slightly better during the election year. I know this chart's probably a little bit hard to read for you, but basically what it says is that the subsequent year after the election, the market is 9.9% on average, and the year during the election, it's returned 11%. So once again, a small margin, but still during the election year, the market has done slightly better historically. And if you see there, basically the last 3 times, Trump and Clinton, Obama, Romney, and Obama, McCain, the market has done quite a bit better in the year after the election, but historically it's been the opposite. So that's all we got this week. That's a little bit of history for you on how the S&P 500 is done during an election year and the year after. We're going to get into the nitty-gritty details. I know you want to hear a little bit more about how it's done under Republican presidents and Democratic presidents. We're going to talk about that. We'll get to that next week. In the meantime, if you have any questions about how your investments might be affected by the election and you don't want to wait on the videos, you know where to find us, 844-CARLSON or carlsonfinancial.com. Thanks and have a good day.